Do we get a Fed pushback after that epic rally that we saw last week that then, in essence, loosened financial conditions?
Yeah, we do. We completely agree. We think that ultimately it's about the level, not the path. We're currently standing at about 3 times their ultimate target. There's a lot of work to be done, and we think they'll remain restrictive. If you look at what happened last week, we actually view the price action to be somewhat unhealthy. And that's really what happens when you have a lot of demand meeting a vacuum of liquidity, and you see those 5% pops. Now, can this have legs? Yeah, we do think it could actually have some legs, and that's because there's a lot of money on the sidelines, and not really FOMO, but there's this fear of underperformance going into year end. So we do think there could be some legs, but ultimately we think we test some new lows coming into next year.
Okay. So there are better buying opportunities coming up, possibly at the beginning of next year. What will be the catalyst for that? Will it be a reassessment of the Fed? Would it be a reassessment of the inflation picture? What is going to drive that?
So on the equity side, we're very much focused on earnings growth. We think this year's been all about the re-rating of multiples. Next year will be about earnings growth. But one of the actual big takeaways for us from last week was actually that there's a temporary ceiling on the terminal rate. We're going to see less rates volatility. And for us, that's an opportunity to reassess some risk assets, in particular credit. There are some pockets of credit we think look extraordinarily attractive. And in the context of, having a 6.5% yield in investment grade credit, we think that there's some real opportunities out there.
Is that a dump equities buy corporate credit situation?
We think we prefer credit over equities. We'd rather be levered to duration than growth at this point. And when we look at IG credit, you're looking at 20th percentile valuations since 2005. Corporate America has addressed their balance sheets. They've termed out the maturity structures. And there's a lot of positive convexity. So when you look at dollar prices on some really high quality names, some that we'll see report this week, they're trading 50, 60 cents on the dollar. So from our perspective, from a long-term holder, that there's really a lot of value there. And that's exactly why you're seeing tourists or non-traditional buyers come into the credit markets right now.
So, Alexandra, let's just explore that a little bit more. Are we in a position where if you are looking for yield and you've been looking at it for it in the equity market, say you've been a buyer of utilities or other similar assets, you should sell those because you're going to get a better opportunity in the credit market? Is that the trade right now? If you're looking for yield, don't go looking for it in spaces within the equity market. You're going to get it in credit.
There's still some attractive yield opportunities within equities. We do prefer to take that yield risk within credit, just given you're up in the capital structure. But you mentioned utilities. So we're focused on some of the more defensive spaces, just given our growth outlook for next year. Utilities are going to be large players in the transition towards a greener economy. They have pricing power. They push it off. So there's still a lot of attractive opportunities within utilities, both within debt and equity markets.
Just headline here, the DAX rises 20% from the September low. It looks to enter a bull market. You like U.S. versus Europe?
We're currently positioned in that way, but there are a lot of catalysts to the positive side that we need to be very thoughtful about. And some of those are, if there's some relief with the Russian-Ukraine tensions, the reopening of China, Europe is very levered to that. So we're cautious and cognizant of not just the left tail risks, but what are the right tail risks in the market and how do we position for that? And where can we find value in doing that?
Alexandra, what does the 60-40 do next year?
The 60-40 portfolio from an outright risk perspective has it's been challenged. Diversification has been difficult. Treasuries haven't given you that ballast. And we've really sought to find that ballast for volatility through commodities, cash, and trend-like allocations. Going into next year, duration's in a materially better starting point. We think that, given that the index has come down on duration, just given the move this year, that yields are up, that you are going to start to get that ballast in portfolios if you start to get, real growth declines going forward.
So Goldman Sachs, and I appreciate it's the research side, not you guys, but they had a note that talked about the core PCE measure declining to 2.9% by December of next year versus 5% now. That feels like a pretty rapid decline in core inflation. If that happens, how do you have to rethink your portfolio?
I mean, our portfolios, given that they're multi-asset, they're structured well and they're well diversified, and given that we're comfortable going into rates and credit, we would be in a very good spot. Ultimately, what we think is going to be important going into next year is what happens with the employment backdrop. So what is that relationship and the interplay between participation, people coming off the sidelines, openings, to people wanting to take jobs? And that ultimately is going to determine what we think will be the type of landing we see. So we think we're well structured and set up from a diversification perspective there.
Alexandra, what kind of inflation rate should we be building in to our expectations long term for our portfolios? Like, people are planning longer term, they need to factor that number in. Is it going to go back to 2%, or is it going to be 2 to 3 or 3 to 4?
I mean, that's the $50 million question. Effectively, what we're trying to say is, like, are there structural changes in the marketplace and the economies that are going to keep inflation higher? We do think so, especially if you see, continued geopolitical tensions, onshoring, things of that nature. And so we ultimately think you should be prepared for a higher level of rates, a higher level of inflation going forward. But just because the Fed is raising rates or we're going to have a higher level of rate doesn't mean that bonds don't have a place in portfolios or that you can't be invested in the market. There's a lot of value and opportunity that's been created over the last year.